I was once a huge buy term, invest the difference proponent when I started in the financial services industry in 1974. That all changed in 1980 when E.F. Hutton introduced a unique concept, buying term, essentially, and investing the difference under a tax-free umbrella. That changed everything, and it knocked the socks off of buying term insurance and investing the difference in a tax-deferred or tax-discerned investment. So get ready. I'm going to explain why a properly structured max-funded IUL is like buying term and investing the difference on steroids. It's totally tax-free, and it is far better than what a lot of those proponents today think you can do, and they simply don't know what they don't know. So I'm Doug Andrew, and I've been a financial strategist and a retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets and minimize taxes and empower what I call their authentic wealth. And one of my favorite financial vehicles, without question, if you've watched very many episodes on this channel, is a properly structured, max-funded, indexed universal life, what is referred to as IUL. So there's a lot of financial advisors that are in the financial services industry that do not understand what I just said. And you can't be aware of something you're not aware of. So I want to educate you because I was a big buy term insurance and invest the difference proponent from 1974 to 1980. And what changed in 1980? Well, first of all, let me tell you that I'm a numbers person, and I did several different charts and graphs showing an individual buying term insurance, whether it's annual renewable term, meaning the actual cost of insurance goes up every single year as you get older, okay? But when you're in your 30s, it's very inexpensive for, let's say, $1 million of life insurance. But every year, the premium goes up. And if you did that, but you invested the difference based upon a set amount that you could afford to set aside, I could prove mathematically that you would end up with a bigger chunk of money than a whole life policy back in the 1970s would accumulate. And I was using rates of return based on actual stock market mutual fund performance, based on Dalbar and what have you, that if you bought and held, that you could earn an average of 9%. And if you somehow could really manage your portfolio and try to time the market, which is very difficult to do, maybe you could earn 12%, okay? And I showed that would accumulate more money if you disciplined yourself, okay? That's key, because if you buy term insurance and you don't invest the difference, then maybe it would be better off if you were to buy a permanent life insurance policy and it was called forced savings. Even though it was a lower rate of return, you actually would achieve more accumulation because of human nature, being forced to set it aside. Now, my attitude when I was young is, well, I'm disciplined. My clients, I'm going to help them be disciplined to sock away the difference. And sometimes I would use 10-year term, 20-year term, but every 10 years, the premium would jump. But in the early years, you had a bigger difference that you could set aside and invest. And I showed investing at 6%, 8%, 10%, 12% rates of return, and I was pretty confident we could earn 12%. Now, one big issue is that at the end of the day, you had to pay tax on that, even if you invested and earned 12% in an IRA or 401k, that's not all your money. If you're in a combined federal and state income tax bracket, and if you could earn 12%, you're not going to net 12. You're going to net 8% in a 33% bracket, okay? So if you accumulated a $1 million nest egg, that's not all your money. Only about $670,000 of that is your money. The rest of it belongs to the government, right? Or if you had $1 million nest egg, and if it was earning 12%, theoretically, you ought to be able to pull out 120 grand a year without depleting the principal, correct? Well, if you pull out 120,000 in a 33% bracket, between federal and state tax, you're going to only net $80,000 to buy gas, groceries, prescriptions, and golf green fees, okay? And I found that savers are usually in higher tax brackets. Now, sometimes people say, well, you'll likely be in a lower bracket when you retire. Well, I found that most savers are not in lower tax brackets when they retire because they were killing their deductions along the way by paying off their house and their kids are gone. Or if their adult children move back in, you can't deduct them anymore. And you're not contributing money to IRAs or 401ks in retirement. You have those deductions anymore. If you're a business owner and you sold your business, you don't have those deductions anymore. And because of irresponsible government spending and the printing of money, most people agree that taxes will likely be higher in the future, okay? And so most savers are not in lower tax brackets. So knowing that, you can't be counting up how much your money is compounding and growing without subtracting the effective taxes and even inflation, which is like a hidden tax. If we just look at taxes, if you conservatively earned 7.5% and you had $1 million nest egg, you withdraw $75,000 a year, you're only going to net $50,000 to buy gas and groceries. Do you understand that? So that's the big issue, the tax impact. You have to subtract the effective taxes and then, of course, inflation, because inflation will double the cost of living every 7 to 10 years based upon actually the real rate of inflation for the last several years. Because the actual rate of inflation is much higher than the CPI, the Consumer Price Index. If you don't understand that, watch some other episodes on my channel. So let's get back to this comparison of buy, term, and invest, the difference. Simply put, if you bought term insurance, and if that term insurance on a given dollar that you could set aside, if the term insurance used up maybe 20% of that dollar, so 20 cents of that dollar, I have the other 80 cents of that dollar that can go into an investment. Now, the truth be known, from age 30 to age 60 or 65, when, the buy, term, invest, the different proponents say you have enough cash now in your investment to equal the amount of insurance you had. If you had $1 million of life insurance to help those that you left behind if you died with an untimely death, well, now you have $1 million, but that's not all your money, okay? In a 33% bracket, you need 50% more. You need $1.5 million. And I haven't even taken into account inflation. But you need $1.5 million because only 2/3 of that $1.5 million is your money, $1 million. So that changes the game a little bit because of the effective taxes. So when you really think about it, I was doing all these mathematical equations showing how much better off you would be. But when you subtracted the tax, I could still outperform back in the 1970s an average whole life policy. If that whole life policy was earning or crediting, 4, 5, or 6%, even if it paid 8% dividends, most whole life policies that touted an 8% dividend were only netting 5.9 cash on cash internal rate of return at age 95. So in order to net, 6 to equal or a little bit outperform whole life, now I had to earn a net after-tax return of 6. So in a 33% bracket, I had to earn 9. That's what Dalbar, who studies investor behavior, says, that if you buy and hold, which most Americans don't do, you would earn 9.14%. You'd be netting 6 after tax. Now, most Americans in retirement are not earning 9%. They're only earning about 3.5%, because when the market goes through these gyrations and it drops 20, 25, 30%, like COVID-19, March of 2020 and so forth, people who have a nest egg and they see that nest egg dwindle by a third, a $1 million nest egg goes down to 650,000. They go, enough already, and they sell and convert to cash, sell low. And then they wait till the market comes back, and then they buy back in high. And that's why Dalbar says the average retiree with money in IRAs or 401ks invested in the market, they're only averaging 3.5%, and that's what precipitated the 4% rule in the financial services industry. That's why most broker-dealers do not want their asset managers to illustrate any more than a 4% payout, which is unacceptable to me. That's ridiculous. To have $1 million nest egg and only get $40,000 a year and you have to pay tax on that $40,000. Even in a 25% tax bracket, you're only netting 3. I can outperform that. And so I used to tout, you know what? If you bought term insurance and invested the difference, and if we really were able to earn 9 or higher, even after tax, we would equal or exceed if you bought and held in the market, okay, which I wanted my clients to do. But we found out that most retirees would not do that. Now, in 1980, that's when E.F. Hutton, who was primarily, they were a brokerage firm, but they also had an insurance company that they owned, and they realized that because of what I've been talking about, most Americans in retirement, they realized that some of the best money managers in the world were the multi-trillion-dollar insurance companies. And all of a sudden, they got this epiphany. Well, what if we bought term and invested the difference under a tax-free umbrella? And it was brilliant. I recognized what they were doing instantly. And I really continued to be a buy term invest the difference proponent, but I agreed we got to have it be tax-free. Now, instead of having to earn, 12 to net 8 or 9, I only had to earn, 10 to net 9. But I knew, but by rebalancing, by visiting with my clients on an annual basis and diversifying and rebalancing, which we talk about on this channel, I've been able to achieve average rates of return a little in excess of 11%. Some years higher, some years lower, but 11. But I can earn 11, and at the end of the day, let's go down the road 30, 35 years, retroactive back to day one of a properly structured indexed universal life. If I gross 11, I can net 10. I can net within 1% of the gross rate of return. Now, a lot of people don't understand what I mean by net. That means you're calculating the internal rate of return, which is if you set aside the money into a max funded indexed universal life. E.F. Hutton came out with universal life, and it was used from 1980 until 1997. And when interest rates started to come down, they introduced indexed universal life so that we could still earn higher rates of return. And this is where I've been able to earn rates of return of 11.17 to be exact, and net 10.07. But depending upon what's going on, sometimes I earn higher than that, sometimes less. Some years you may not make anything, but you don't lose. That's the value of indexing on universal life. But let me simplify this for you. I realized that if I bought term insurance and I invested the difference, if I kept the term insurance in force until I was age 60 or 65, when theoretically I could get rid of it because supposedly my money invested would grow to equal, the insurance I had to make sure I had 50% more money accumulated in a 33% bracket. So that means I had to have higher rates of return. So this is what I discovered. In order to equal what a max funded index universal life does, where I can earn 11 and net 10, if I bought term insurance and invested the difference, not only would I have to discipline myself to invest the difference, but even starting at age 30, I would have to invest probably 80% of every dollar and get a rate of return that was 20% greater than the return I got on a tax-free indexed universal life to equal the same amount of money. Now, if you don't know what I just said, is if I can earn 11 and net 10, if I bought term insurance and invested the difference, on that difference, because I have to use some of the money for the term insurance, and term insurance, that's money down the drain if you don't die, okay. So on every dollar, if I only have 80 cents of that dollar to invest, I have to earn now 12 or 13% in order to have the same net rate of return, because of taxes. If I have to earn 12, even in a 25% bracket, I'm only netting 9. I can earn 11 and net 10. So in order to equal an index universal life where I can earn 11 and net 10 cash on cash in a 33% bracket, golly, I have to earn 15% to net 10. So I'd have to earn 15% rates of return, but I don't have the full amount, 100% of that dollar, because I'm allocating 15, 20, 30% of it, depending upon how old you are for the term insurance, towards the term insurance. Does that make sense? And so if I have less money out of every dollar because I have to still have money for the term insurance, I only have maybe 80% of that dollar average from age 30 to age 65 to invest to the difference. And because I have less money than the whole dollar going into universal life, and people say, well, there's costs in universal life. Yes, that's what I'm talking about. The costs are only draining out 1% retroactive back to day one. I earn 11. With all the costs, I'm netting 10% cash on cash. In order to have the same amount of money after tax when you're investing the difference, I have to have a rate of return that is pretty risky to try to earn, 13, 14, 15, 16% rates of return. To earn that, you've got to take some unnecessary risks. That's when I became a big buy term invest the difference proponent under a tax-free umbrella by using max funded universal life and then later on indexed universal life. So if this is arousing curiosity, you ought to check out and actually see a properly structured max funded indexed universal life. And whatever rate of return, if you max fund it properly, you'll see that if at the end of the day, at age 65, when you could get rid of the insurance, when you finally have enough money, that's what you're doing with Index Universal Life. The cash value often grows to equal and exceed the death benefit within 10 to 15 years for our clients. Now you are self-insured. That's why I call it buy term invest the difference on steroids. So if I have an individual, especially an older one, and they want to reposition $500,000, the minimum amount of insurance is $1 million on Index Universal Life. That $500,000 they put into that policy in the first 5 years will grow to equal the death benefit, usually by the 10th or 11th year. Now they have bought term and invested the difference. Their investment in the insurance has grown to equal the death benefit. They're getting rid of the cost of the insurance. The actual insurance now costs you nothing, except if you happen to die. The insurance company pays out 5% more than the cash value. But the cost of that is minuscule compared to the interest you're earning because now you're self-insured. If you've never seen an insurance policy that gets cheaper as you get older, you need to check out a properly structured max-funded indexed universal life because that is buying term and investing the difference tax-free. And it will outperform anything you can show me by buying term and investing the difference unless you think you can earn 18, 19, 20% year in and year out average and then pay tax on investing the difference. And I've yet to see anything that will average that in the long term. So I'm still a buy term invest the difference proponent. I just like it under a tax-free umbrella. And I like it with a conservative rate of return where I can earn 11 and net 10 instead of having to earn 16, 17, or 18 to net 10. So if this is intriguing you, you can check out this episode up here. And also, if you want to read our most recent best-selling book, The Laser Fund, on Amazon, it retails for $20 up to $60. But I'll gift you a copy free. Simply click on the link below, and you can contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, and I'll pay for the book and fire out a hard copy to you via priority mail. Now, regardless, when you're in there claiming a free copy, if you like to listen and learn or watch and learn, there's options for that. But we also teach educational webinars that are free, no charge. But also you can schedule an appointment to talk to an IUL specialist to see actual illustrations of a max-funded IUL and take the same amount that you can set aside into an IUL over a 30-year period and then compare that to buying term and investing the difference, and you'll understand what I'm talking about. And you need somebody who's savvy instead of them just saying, oh, that's a bunch of, BS. No, prove it. and I can prove it to you mathematically. So this is not about me, this is about you, and hope this has given you some insights that maybe you didn't have before.